Picture this. 1844. Montgomery, Alabama. Three German immigrant brothers, Henry, Emmanuel, and Meyer Lehman, open a small general store. They sell dry goods, seeds, and tools to local cotton farmers. A humble beginning, right? Who would have guessed that this tiny shop, H. Lehman, would one day become a global financial behemoth, a titan of Wall Street known as Lehman Brothers? This isn't just a story about a bank. It's a story about ambition, about survival, and about a fatal flaw that brought a 158-year-old empire to its knees. For over a century and a half, Lehman Brothers was more than just a name. It was a symbol of Wall Street itself. It weathered the American Civil War, transforming itself from a cotton commodity trader into a full-fledged financial firm. It survived the panic of 1907, the Great Depression, and 2 world wars. It financed railroads, department stores, and even the film industry. When you think of the iconic history of American finance, Lehman Brothers is right at the heart of it. They weren't just participating in the market. For a long time, they were the market. Their name was synonymous with stability, prestige, and relentless success. It was a Wall Street dynasty that seemed untouchable, immortal. But as we all know, the bigger they are, the harder they fall. And Lehman's fall would shake the entire world. So, how did this giant, which stood tall for 158 years, crumble into dust? The story of its demise begins in the early 2000s, with a seductive and ultimately toxic new opportunity: the subprime mortgage market. Now, to understand this, let's break it down. A regular, or prime, mortgage is a loan given to someone with a good credit history, a steady income, and a solid down payment. They're a safe bet. A subprime mortgage, on the other hand, is given to borrowers with poor credit and a higher risk of defaulting on their payments. For years, these loans were a niche, risky product. But in the early 2000s, everything changed. Interest rates were low, and housing prices were soaring. Wall Street, in its insatiable hunger for higher returns, saw a gold mine. The logic seemed simple. If deeply flawed, package thousands of these risky subprime mortgages together into complex financial products called mortgage-backed securities, or MBS, and collateralized debt obligations, or CDOs. The idea was that by bundling them all together, the risk would be spread out. Even if a few people defaulted, the majority would keep paying, and the security would remain profitable. Credit rating agencies, who were supposed to be the impartial referees, stamped these incredibly risky products with AAA ratings, the safest investment grade possible. It was like putting a certified organic sticker on a box of poison. And Lehman Brothers, they didn't just dip their toes in the water. They swan-dived into the deep end. Under the leadership of CEO Dick Fuld, nicknamed the Gorilla for his aggressive and competitive nature, Lehman became one of the biggest players in the subprime game. They weren't just selling these mortgage-backed securities. They were underwriting them, buying them, and holding massive quantities on their own books. They acquired several subprime lenders, like BNC Mortgage and Aurora Loan Services, putting them right at the source of these risky loans. For a while, the strategy worked brilliantly. The profits were astronomical. The firm's stock price soared. Bonuses were record-breaking. And the confidence inside their headquarters at 745 7th Avenue was sky-high. They believed they had unlocked a perpetual motion machine of profit. They were convinced that housing prices would only go up, forever. This wasn't just a miscalculation. It was a systemic failure, fueled by a potent cocktail of greed, hubris, and a dangerous lack of regulatory oversight. The system of checks and balances had failed. The belief was that modern financial engineering had somehow eliminated risk. They were wrong. Terribly wrong. The success was built on a foundation of sand, and the tide was about to go out. The first tremors began in 2006. Housing prices, which had been on a relentless upward climb, began to stagnate and then fall. All those subprime mortgages, often issued with tricky teaser rates, began to reset to much higher interest rates. Suddenly, homeowners who could barely afford their initial payments were faced with bills they had no hope of paying. Defaults began to skyrocket. That diversified portfolio of mortgages. It turned out that when the housing market collapsed, it didn't matter where the houses were. They all went down together. The mortgage-backed securities and CDOs that were once worth billions became toxic, impossible to sell at any price. They were financial, radioactive waste. For Lehman Brothers, this was a catastrophe. The firm was incredibly leveraged, meaning they had borrowed huge amounts of money to make their bets. The high leverage strategy is great on the way up, as it magnifies your profits. But on the way down, it becomes a death spiral, magnifying your losses to an unbearable degree. For every dollar of its own capital, Lehman had borrowed and invested around $30. When the value of their mortgage assets plummeted, their capital was wiped out with terrifying speed. Throughout 2007 and into 2008, the situation grew more and more desperate. The firm tried to reassure investors, claiming the worst was over. Dick Fuld publicly insisted the firm was sound. But behind the scenes, a frantic scramble was underway. They were trying to sell off bad assets, raise new capital, and find a buyer. But the damage was too great. The market had lost faith. Other banks, sensing weakness, stopped lending to them. Lehman was hemorrhaging cash. A final, dramatic act played out over a single weekend in September 2008. The U.S. government, having already bailed out Bear Stearns earlier that year, drew a line in the sand. Treasury Secretary Henry Paulson gathered the heads of all the major Wall Street banks and made it clear. There would be no public bailout for Lehman. If it was to be saved, it had to be a private solution. Frantic negotiations took place. Bank of America and the British bank Barclays were the final potential saviors. Bank of America pulled out, opting to buy Merrill Lynch instead. Barclays made a last-ditch effort, but the deal collapsed over regulatory hurdles. Time had run out. On Monday, September 15, 2008, the unthinkable happened. Lehman Brothers, a 158-year-old pillar of global finance, filed for Chapter 11 bankruptcy. It was the largest bankruptcy filing in U.S. history, with over $600 billion in assets. The news sent shockwaves across the globe. Employees were seen leaving the Lehman headquarters, carrying their belongings in boxers, their faces a mixture of shock and disbelief. The stock market went into freefall. Credit markets froze solid. The domino that Lehman represented had fallen, triggering a chain reaction that brought the entire global financial system to the brink of collapse. The Great Recession had begun. Looking back, the fall of Lehman Brothers is a cautionary tale for the ages. It is a story of how a firm that survived wars and depressions could be brought down by its own hubris and greed. It wasn't a sudden event. It was the result of years of taking on invisible risk, of chasing short-term profits while ignoring long-term consequences. Then of a collective belief in a market that could never fail. The collapse revealed deep flaws in the financial system and led to sweeping new regulations aimed at preventing a similar crisis from ever happening again. The legacy of Lehman Brothers is not in the skyscrapers it financed, but in the lessons learned from its spectacular downfall. It serves as a permanent reminder that no one, no matter how powerful, is too big to fail. Thank you so much for watching. The story of Lehman is complex, and this is just one part of a much larger picture. If you found this interesting, please hit that like button and subscribe for more deep dives into the stories that shaped our world. Let us know in the comments what you remember from the 2008 crisis. See you in the next video.